Okay, good evening, everyone. Good evening, everyone out there. Thank you for logging in. This is the Taxco 2020 tax filing webinar. Here today is I'm your host, Carlyle Fraser, and my co-host is,
Carlos Fraser.
and we're going to be having a good time today. We're going to be giving you a lot of information, and because that's what we do here, we like to educate our clients because the big picture is building wealth. Building wealth is the big picture, and tax parting or tax season or tax filing is just one part of it.
Yeah, so definitely what we're going to do is really get into the big information. We only have an hour, but our goal is to try to give you as much information as possible. And what you're going to realize is that the only way to grow wealth is to have knowledge. And we're going to try to feed you as much knowledge as possible so you can keep more money in your pocket. So time to get ready. Let's jump right into it. So how this webinar will work is that you can raise your hand and you can put questions out there, but we won't be able to look at that until the end of the webinar. We have a lot of information to go through. There's a lot of things that are changing as we speak with the new stimulus package. So we only have an hour, so we're trying to use that hour as much as possible.
Yeah, we're going to try to go through the presentation as quickly as possible. And as we said, we're going to keep the questions to the end.
Correct. All right, so there's a couple of things we're going to talk about. The first thing is the new office procedures due to COVID-19. It's going to change. It has to change. Everyone changed because of COVID, and our office procedures have changed. And then we're going to go into how to be organized for the 2021 tax season. What is organization to us and how we're going to help you be organized. And then we're going to talk about the CARES Act and how the CARES Act affected the personal as an individual and how it affects business also. Then we're going to have some tax tips for 2021 of what you should do. And then we're going to throw a little bit of the new tax law.
Right? Because a lot of things are changing, man. It's changing like
Every
crazy.
single day is changing. So let's talk about the new office procedures. So new office procedures and how it's going to work. We're going to have about 3 options that are available on the table. So option 1 or 2 is basically in office.
In office. Well, the people who came into the office, say from like March straight through to like
December.
December,
Yeah.
really experienced our COVID.
There's a very good point. There's a very good point. As soon as COVID hit, we were still open. We were open throughout the whole thing, still filing people's tax returns because they needed the money. And a lot of people took option 3 and 1 and 2, and a mixture of all of them together. But we basically have 3 options that we're putting on the table. Where option 1 and 2 is some form of mixture of coming into the office for a short period of time and dropping off your information. And option 3 is totally virtual, which we had to kind of get used to.
Yes, we got to get used to it.
So with option 1, you drop off and you pick up your information, you drop off your taxes and your worksheets, and you leave it with us and we process it and we'll give you a call back if we need any more information. You come back and pick up that information or we upload it in the portal. And we've been doing this for how many years now?
We've been doing this since 1997.
1997.
Drop-off system. And our drop-off, we have a secure drop-off box.
Correct.
That it comes straight into the office.
Yeah, so we have a secure lockbox that kind of drops straight into the office, so no one can put their hands in to get the information if you drop it off after office hours. But it works so well, and a lot of clients, they love that drop-off feature where they drop it off, they can pick it up, and it's done. It's like magic.
We've been doing that for 10 years plus.
Yeah. Information that are flowing through the emails are not secure. So we know a lot of people sometimes send us information as to birth certificates, social security cards, your tax information. We want to move a lot of that off of the email and into the portal. So the portal is very, very good for us. Then option 2 is an in-office meeting or pickup. So what would happen is you would schedule an in-office meeting for about 10 to 20 minutes to sit down in the front conference room or one of the rooms to limit the amount of time that you are in the office. And then we will go over your information and compare it to last year and see if there's anything missing and talk about any questions that you may have. We'll process the return and then we'll either upload it into the portal or you have the ability to come into the office and pick it up. So that's a little bit new, because as you know, sometimes we have the ability for clients to sit down and get their taxes done, and we're really not doing that. Not too much this year, so that's kind of off of the table.
Well, you could wait in your car.
You could wait in your car. I mean, you can wait in your car if you want to, if we have enough time to process the return.
But it's gonna come as you know, day-to-day basis, you know, as we see how it rolls, and then we just deal with it then.
Yeah, because everything is changing. There's a lot of information that we have to really go through to make sure your taxes are prepared in the correct way. So honestly, I don't think you should wait in your car. If it's a simple return, we'll let you know. But more complex return, you need to give us more time to basically work on it. And then option 3 is to upload your information into the portal, and we either set up a Zoom or a call. So it's kind of similar to option number 2, but the only difference is, instead of scheduling a meeting to come into the office, you schedule a meeting, either a Zoom meeting or a Google Meets meeting or a call. You upload your documents into the portal rather than dropping them off. Then we'll schedule a Zoom or a call to go over your documents. Once again, we'll look at what you had last year, compare it to this year, to get an idea of where you're at, and ask you any questions. Or if you have any questions for us, you'll ask us, and then we process your return, and then the taxes will be uploaded in the portal. Is there anything you wanted to say about the portal that you wanted to point out?
Well, when it comes to the portal, we must have your email address. Your email address, or your email address that you use on a regular basis, that's the email address we should have. So if we don't have your email address, or you haven't been receiving emails from us, if you have old email address, just let us know and update your email address.
Yeah, I would definitely say update your email address, because that's where it's going. And one other thing I would like to say about the portal is a secure way for us to send you information. Items are not stored on the portal. So I think after about 15 days, 30 days, after 30 days, the information that we send to you in a portal basically disappears for security purposes. We still have it on our side of the portal, but when we send it to you, it only stays in your portal for 30 days, and then it disappears. So when we send you your tax return or any information, we ask that you download it to your secure, if you want a Dropbox or Google Drive, whatever you want, just download it, because we get a lot of calls about things are not in the portal anymore, but really it disappeared after 30 days.
You have to access it in 30 days. And one other thing with the portal, when you send your documents, try to send it in one PDF. If you send a document in one PDF, it helps us a great deal than to send us like 50 PDFs.
Yeah.
You know, so try to get the documents in one PDF.
Yeah. Close that door for me. All right. So with all the options, I want to definitely let you know the turnaround time is going to be definitely slower compared to the past. In the past, we would finish a return basically either if you came into the office that same day, or if you dropped it off, it would take us about 7 days. Right now, we're projecting it's going to take at least 2 weeks. Not saying it would be 2 weeks, but you have to give us at least 2 weeks to complete the return. Because once again, there are so many things that are changing for 2020. We need ample amount of time to review your information and see what tax laws apply to you and what elections apply to you. Once again, once we get deeper into the webinar, you will see that there's some things that tax law that are changing today when the president signs that new stimulus bill that will affect your 2020 tax return. So it's going to take us a little bit longer than usual. So be mindful of that 2 weeks to complete at least a minimum.
Yeah, 2 weeks is a good time, but sometimes you go over something, you go under, but 2 weeks is a good time with this COVID.
Correct. So how to get organized for your 2020 tax
organization
filing.
Man. Organization.
And that plays back to us talking about the 2 weeks. The more organized the person is, the faster we can get the tax return out, because we have a system and a process that's been inside the company since 1999 or 96.
97.
Since 1997, we had a system on how we process returns. So organization helps a great deal. So, well, I think the biggest thing we like to talk about is we need your annual totals. We do not need the itemized receipts. Keep the receipts in case of an audit. And what that means is people who come to the office with a box full of receipts, I mean, that's great that you have that, but it takes us time to go through those said receipts to total those items up. So I would definitely say take the time and do those totals yourself, because all we need is the totals to put onto the tax return. The receipts that you have, you would keep it just in case if there's an audit, you can go back and refer to those documents.
And the totals should be categorized. If you use our worksheet, you could use those categories on the worksheet and categorize the totals too. That would help.
Correct.
That would help a lot. Speed up the return.
Correct. So sometimes people ask, what do I need to file my taxes? So on our website, if you go to taxco.co, which is taxko.co, we have a tax preparation checklist. And that checklist goes down every single thing that you would need. We list out every single tax form. We list out every single item that is applicable for your tax situation on that said checklist. So if you go through that checklist, you will see what you would need if you had a new child, if you are claiming a dependent, if you received unemployment, if you changed your job. We have went down the list of all the items, and that's located on our website to do that tax preparation checklist. It's very helpful if you would go through it, because it would kind of let you know exactly what we would need to prepare the tax return.
Yeah, I think that checklist is good.
Yeah. So in addition to the checklist, what we have done is that we have created forms. So the forms you see highlighted there, we have the client annual data form, which basically asks you if you change your address, any pertinent information. Did you sell any stocks? Did you buy any stocks? Did you sell your home? Did you purchase a new home? Any of those informations are located on that client annual data form. Then we have the personal expense worksheet, where basically goes over, your medical, your dental, and any other expenses. And then the Schedule C worksheet. What about the Schedule C worksheet?
Schedule C worksheet is typical for self-employed persons who receive 1099s. You use that worksheet to put your expenses and as well your income. And it's a very detailed worksheet. You go through it, you'll see where you put all the information. And I must say, use the website, use our website, use the forms, Schedule C, the Schedule E, the rental piece, the rental property piece,
Yeah.
whereby you could itemize your rental expenses and your rental income.
Yeah, so what we have done is every year we go through the tax code and see what's changed, and we update these forms. Like take, for example, in 2019, when or 2017, when Trump came into office and changed the tax law, we changed it for that said tax law. So once again, with these new tax laws that are coming out, we'll change it. So by January 15th of 2021, we should have everything updated on our website for the 2020 tax filing. But we definitely please ask you to fill out those worksheets, especially the client annual data form, because we process a lot of returns during the day. So we look at that client annual data form to see if your address has changed, if your phone number has changed, are you removing any dependents? We sometimes catch these items when we do our final review and we call you up and say, hey, we see your W-2 has a different address. Is it different? But it just delays it and we would like to just move as fast as humanly possible. So use the forms.
And most people say nothing changed,
Yeah.
nothing changed. But when you go through the whole process, a whole lot changed. They bought a house, they had unemployment, but they said they moved and they said nothing changed. So just go over the form.
Yeah, definitely.
Just take the time to go over the form.
Correct. All right, so we're going to jump into the CARES Act. So the CARES Act was a tax law that was passed once COVID-19 hit in March of 2020. And it basically had a lot of things piled into it. Of course, we can't go over every single thing that was in the CARE Act, but we'll go over the top things that are for personal and business. Some things you have a couple of days to still strike while the iron is hot, and some things are going to flow over into 2021. So, like I said before, the CARES Act covered individuals, and it also covered business. So the first one we're going to talk about is for individuals. And of course, we cannot forget the stimulus. Oh my God. The stimulus was a lifeline for a lot of people, and it was money that was definitely needed. And some people received that stimulus check in 2020. 1,200 for individuals, 2,400 for married couples, another 1,200 for head of household, and 500 in addition for a dependent child. Now, what we would like to explain is that this money was in advance for your 2020 return. So if you have not received it yet, or you haven't filed your 2019 return, when you come in to file your 2019 and 2020, it will be a credit on your 2020 tax return. So I think that is a good informational piece that, you know, if you did not receive the stimulus or the amount that you feel you should have received, when we do your 2020 tax return, we'll be able to do a reconciliation.
Yeah, because 2020 is the year that you're going to look for your AGI,
Correct,
for your income, and all of that stuff to make sure that you qualify for that stimulus. So if you did not file, you know, 2020 is the filing year that's going to determine everything.
correct. So in this chart, what we show is that the highlighted amounts for single, 99,000, for married, 198,000, head of household, 136,000. We will look at your income for 2020 and see if you went below that. So let's take, for example, if you're a single person and in 2019 you made 150,000. COVID hit, you lost your job, you're on unemployment, your income dropped down to $85,000. We will be able to get a $700 credit on your return for the stimulus. So as you can see, it is based on your 2020 tax return. Doesn't matter how much you received, and then vice versa. If your income went up in 2020, the government does not want you to repay that money. So let's say you're single and you were making, I don't know, $75,000 before COVID, and you're a nurse practitioner, and then boom, COVID hit, you're doing overtime, you're making a lot of money, you made $150,000, you got the stimulus, they will not ask you for that money back. And I think that's a good thing for the government.
That's a good thing, because the last stimulus back then, they hit you back for that
Yeah.
money.
So
They hit you back for that money.
yeah, so what he's talking about is when Obama came into office, there was a stimulus check, and if you went over the threshold, you had to repay that money. So I think they learned from that and changed it out. So there's a notice that you'll get. It's called a 1444 notice. We definitely ask you, if you can find that notice, bring it with you so we can cross match that to your return, because when more than likely when we do the return, it's going to calculate what they think you've received, and we want to get the exact amount paid. So remember, this amount is not taxable income. So look for this form if you have it and bring it in with your documentation. If you don't, just let us know. On a client annual data form, we will have a question of how much stimulus you received, and you can indicate either on a client annual data form or the personal expense worksheet. We'll ask you that question. So, you know, enter that information in. But if you have this letter, it makes life so much easier for us because we know exactly how much you received. And when we enter an amount on the return, it's basically a reconciliation. So one thing about the CARES Act, it had unemployment. Unemployment is taxable income
on the federal side.
On the federal side. In the state of New Jersey, it's not. New York, it is. Yes. So some states it differs. But we need that unemployment information. If you receive that pandemic unemployment, that additional $600, and then it went down to $300. We need that form. So there's two main points that we would love for you to understand. The first point is we need a 1099-G from unemployment.
Yes, we need that 1099-G. Not the notice, not the benefit notice, the form that says 1099-G. And I think you have to log into your unemployment, right?
Yeah, New Jersey is you have to log into your unemployment to print out that form. Some states like New York, may send it to you. California, Florida will send it to you. But New Jersey, we definitely know you have to log in. New Jersey will not mail it to you. You have to log in. So that's the very first point. We need that 1099-G.
And just we want to stick a point, because if they're out of unemployment, they may have to re-register to re-register into the system in order to get the 1099.
Correct. So if you are no longer receiving that unemployment, usually every January they change the username and passwords, so you have to re-register. And if you're still on unemployment going into 2021, let us know, and we'll look at the withholding of your taxes, because if you were not withholding any taxes on your unemployment, it's going to affect the return drastically. And I think another point is that unemployment does not help to calculate earned income credit or child tax credit.
Yeah, it's true. But I was reading something last night in the new act. They want
the look back.
They want to make sure that taxpayers are not penalized.
Correct.
Because they went on unemployment, they lose their wages and they lose their own income credit. So there's some talk on that.
Yeah. So in further down in the webinar, we'll go over what that look back period would look like. All right. So another thing that happened with the CARES Act is that they're allowing you to dip into your retirement funds and not pay the 10% penalty. So in the past, if you took money out of your retirement fund, it is taxable income on the federal and state side, but we were able to sidestep that 10% penalty if it was for purchasing your first home, medical expenses, higher education. So now that 10% penalty is waived. So when you take the money out, even though it will be taxable, there's not an additional 10% penalty. And how the CARES Act was written, it was a coronavirus related distribution or to the individual. So they said either you're diagnosed with COVID-19 or your spouse is diagnosed with COVID-19, or you experience an adverse financial consequence. But at the end of the day, it's everybody.
Yeah, it's everybody. And the other thing with the 10% penalty, is the age 59 and a half.
Correct.
If you're under 59 and a half and you took it, then that 10% penalty can apply to you. But if you're over 59 and a half, it's mute. Yeah,
very true. It's a mute subject. And another thing, I don't know if the new law, I didn't get to read it because it's like 5,000 pages, if they extended the ability to do it, because as of right now, you have to do it before the end of 2020 to qualify for this 10% penalty waiver. So with that 10% penalty waiver, we want to let people know you have the ability to basically take a loan from a 401k. You don't have to take a withdrawal. A loan, they changed the rules on that, is increased to 50,000 to 100,000. So meaning that in the past, the max loan you can take out for a hardship from your 401k was about 50,000, is now increased to $100,000. And then there used to be a 50% accrued vested cap. So if you vested, I don't know, $10,000, you were only able to pull out $5,000 of that vested amount. They have made it 100% of what you vested in your 401k. So if you take a hardship withdrawal, you can take 100% of your vested amount. And one of the good things is now that with the CARES Act, with the 401k, if you take out a loan rather than distribution, the repayment doesn't have to start right away. You can delay it for at least 1 year. So I think that is a really good thing, and it's not taxable. So if you take a distribution, it's taxable. If you take a loan, it's non-taxable. So I think that was a really good thing that the CARES Act put forward. Yeah. And once again, you still have time to do that. You have till the end of the year to do that. I know a lot of clients have called in during the year, and we advise them that loans are better, but if you can't take a loan, you just take a distribution. All right, so with this distribution of the money, if you did not take a loan, you took a distribution, the IRS is giving you two options, which we would, explain to you. So let's take, for example, if a person took a distribution of $9,000, they could take option 1 and report that $9,000 as taxable income in 2020. Or they can take option 2, and there's an election on your tax return to split it over 3 years. So that even though you received the $9,000 in 2020, we get to split it over 3 years. So $3,000 in 2020, $3,000 in 2021, and $3,000 in 2022. Once you make the election, you can't go back. So if you make that election, we basically have to stick to it regardless of how you pay it back or not. We'll go into that. So when you repay the money, it goes with those options too. So let's take, for example, option 1. You took $9,000 out as a hardship distribution from your retirement plan, and you paid $5,000 back. You could have paid the $5,000 in 2020, 2021, or 2022. We would take that $5,000 off of your 2020 tax return. So if you paid it in 2021, we'll have to amend your return. If you took option 2 and you paid back the $5,000, let's say you paid it back in 2021 or 2022, we have to go back to the first year that you made that election. So that $3,000 would come off 2020, and then the other $2,000 will come off of 2021. What we're basically trying to say is that once you make the election, no matter when you pay it, we have to go back to 2020 and make the adjustment of how much you repaid and then move forward. So if we do take the election and you do repay it, that's something to really know about, that we have to go back to 2020 first if we do the repayment. So there's 2 changes to the charitable donations. So the first change I know my father really loves because he has a non-for-profit, and you were doing a lot of things in 2020, and a lot of people were donating to that non-for-profit, and a lot of people felt like, oh my God, well, I may not get a tax deduction for this. And in the past, they were correct. If you made a contribution and you weren't itemizing, you really didn't get a tax deduction. But with the new CARES Act, they allow you up to $300 of cash contributions. How does that make you feel?
Oh, that feels good. And we make the client feels good too, the person who's making the donation, because at the minimum, you got $30 there, man. And
$30.
Everything comes.
Yeah. So I think the good thing about it is that you do not have to itemize. There's a lot of individuals with the new Trump tax law. The standard deduction that the government gave you is high. For a single person, it's $12,400. For a married person, it's almost $24,000. So if you don't own a home, and especially if your mortgage isn't that high, you may have to take the standard deduction. So you could put money into charitable contributions you didn't get a benefit for. With this new CARES Act, they allow you that $300 cash contribution. So you have until basically now in December to make a contribution to a non-for-profit or your church. Even if you don't itemize, you'll still get the benefit of that contribution. And then the other change is that the cash contribution is no longer limited to the amount of money you make. So in the past, what would happen is, let's say you made $50,000 and you donated $26,000 of contributions. We would only be able to take 50% of your income amount. So we don't even take 25,000. Now they allow us 100%. I don't know if this is going to flow over with the new law, but what we've been telling clients, if you have the ability, start your own non-for-profit. This is the best time to do it. If you have a mission that you would like to accomplish, let's create that non-for-profit for you, because you can make a donation to that non-for-profit and help any organizations that you want, and help your own non-for-profit.
Yes, and you still get 100% deduction. And not because they have this 300 cash deduction, the people who do itemize, who are not using the standard deduction, should still make those other charitable contributions, the cash and the non-cash contributions, in order to save some taxes on the contribution side.
Yeah, definitely. So I guess what we're saying is that the $300 one, the government's basically giving you $30. So because at the 10%, the lowest tax rate is 10%, 300 times 10% is $30. They're automatically giving it to you. But what we like to say is that you definitely have some form of proof. Right now, how we read the law is cash contributions. So we're really looking at it as more of cash, like to a not-for-profit. You're putting some form of cash, but you want some form of a letter. We want to have some form of proof that you made this. Canceled checks are good, but a letter from the organization is even better. And hopefully that letter does not say no goods or services were received for this. So let's take, for example, if you went on a golf outing, well, I don't know how you could go on a golf outing in 2020, but let's say you contributed to a non-for-profit and they gave you a swag bag with goodies in it, a mug, and they indicated, thank you for your donation of $100, $25 was for the mug, $75 is what we can deduct on a tax return. So those letters definitely help us out to figure out what is the correct way to take that charitable contribution. And then now, like I said before, the IRS is giving basically high income clients the ability to make a large amount of donations and not having it being subject to 50% of your income. You could go above that. And one thing I like is that the S Corps and LLCs, you could donate food inventory. So in all of our restaurant clients out there, if you have food at the end of the day, you can donate it to your local food bank and we can get that. It'll be treated as cash and we can take a donation of that on your tax return also. Once again, be sure to get proof of it. And like we said before, we don't know if the new tax law, because once again, it's 5,000 pages. We don't know if the new tax law allows us to push this into 2021, but if it is, this would be something.
This is something that you should really look into to make sure that you could do that. But with the inventory side, sometimes if you have that inventory in your purchases and your cost of goods and we're deducting it, then we can't double dip and go on top of it.
Correct.
And deduct it as charitable contributions again. So these are stuff that are not in your cost of goods and that we could deduct as contributions.
That's a very good point. So another thing that happened with the CARES Act is that now if you're with an employer, your employer could pay your student loans and it would not be considered taxable wages. So in the past, what would happen is if you are working at a large employer and they're paying for education, it's the same type of plan, but now the CARES Act put a little wording in there for student loan interest. So the limit is $5,250 that your employer can pay towards your student loan interest, and it would not be considered income. And as of today, it expires on January 1st, 2021. Once again, we don't know if this is going to be extended, but if it is, if you have an employer that has a tuition reimbursement program, definitely reach out to them to see if they would do the student loan. And for self-employed individuals, we've already looked at it in tax planning. It's really not going to work because if you are a 5% owner or more of the said entity, they don't allow you to do it. So I know the calls will come in that, can I pay my student loan through my business? If you're a 5% owner, no, it would not benefit you, unfortunately. And one thing that we have to understand is if your employer is paying that $5,250 max, the interest would not be deductible on that part. So if we realize the interest that they paid in that $5,250 is $50 worth of interest, we would not be able to take that $50 worth of interest on your tax return. But I mean, who cares?
Yeah, but I'll say what you say earlier. They got to reach out to the employer.
Yeah.
Reach out. The most important thing you just said there is they got to reach out to the employer to make sure that they have this tuition reimbursement plan and tell them, look, we could have our student loans paid through this.
Yeah.
That's
yep.
the key to this.
And the key word is Section 127 plan. If they have a Section 127, but if they have a tuition reimbursement plan, they have a 127 plan. So this is something that they can do. Some employers may not even know that this even exists. But once again, we have until January 1st, 2021 for you to take that and have that deduction with the CARES Act. So that's basically the top things for the individuals. And for our business owners, even if you're in the gig economy, if you are an Uber driver or you deliver stuff, if you have a business, the CARES Act has a lot of things in there for you too. So the first one was the EIDL. So yeah, the EIDL was wild. You know, we sent out an email as soon as it dropped to let people know that to apply for it. So the EIDL is an advance. So the grant amount, the amount that they gave you, they said 10,000, but it was really 1,000 per employee. Yeah, so that amount is considered the grant portion, and there was another portion that was a loan portion that was over 30 years. These are things that are not subject to repayment. You don't have to, well, the grant is not subject to repayment, the loan is, but the grant is taxable income. So if you received, let's say $1,000 of EIDL grant, we are going to report it on the tax return under your business as other income. It will not be subject to self-employment tax of the additional 15%. It will just be other income, but we need to know. So if you are a business owner and you're using that Schedule C worksheet and you're putting that income in, let us know if you received that EIDL. I'm sure we're going to have to ask that on the form if you receive EIDL or PPP, because that grant portion, we don't want the additional 15% tax to be taxed on top of that. So the EIDL, that's the big thing to know. It's not the loan portion is not taxable, but the grant is. So that's the biggest takeaway that we would say from that. Anything else from the EIDL?
You don't want, as you said it earlier, you don't want to commingle.
Correct.
Your loan with your income.
Yeah.
Because you don't want that to be double taxed.
Correct. The loan is not taxable income. The grant, the advance that they gave you of $1,000 is. So be very careful about that. So the Paycheck Protection Program, what we learn now is expanded even more. But with the Paycheck Protection Program, the PPP is not taxable income if kept alone. And the reason we say that is because if it's a loan, even if it's forgiven, it is not taxable income at all. If you take forgiveness, we may have to reduce your expenses, but the new law came out saying that if you have covered expenses, we don't have to do that. We can double dip. So let me just give you like a quick example so you understand. I think I moved it. But basically what we're saying is if you had a $50,000 in PPP and you took forgiveness of that and you paid it to payroll, now they're allowing you to take the deduction for payroll. In the past, as of yesterday, or well, the law is not signed yet. So until the law is signed, as of right now, if you took that forgiveness, we would not be able to take that $50,000 as payroll expenses. We have to remove that off the tax return. So we really need to know where your PPP went. And this is where bookkeeping comes into play if you're a business owner. So I would say get your books and records together as much as possible and kind of give us an idea where that PPP went. So the employee retention credit, I don't think a lot of people really did the employee retention credit, even though it was is a great program because they extended it. And basically what happens is the credit is not taxable and it has been extended to July of 2021. So basically if you are an employer and you have people who are working and they're working through these times, you can basically pay them and get a credit from the government.
Yes, and they'll send you a check.
Yeah.
They'll send you a check. They'll refund you that money that you paid.
So we cannot take a deduction of the payroll taxes that was not paid. So if they gave you a check for $5,000 for payroll taxes and your total payroll taxes for the year was $10,000, we can only take that $5,000 amount. So I think that's really good. So the overpayment that is refunded to you is not taxable income. It's basically them giving you back a credit.
Yes, and it depends on how your books are structured. Because if you're showing that you paid a full amount, it would that refund would have to be deducted.
Correct.
So that you don't
double dip. So as you can see, there's so many things that we have to look at, and that goes back to the 2-week time frame for business owners, maybe more than 2 weeks, especially if you received the PPP, the EIDL, or you took this employee retention credit. It may take a little bit longer than that.
Well, let me just, as you mentioned, the business owners, this is time for them to get up their bank statements and all of that good stuff. and bring it in. Just
Yeah.
if we do, your bookkeeping, I think you should start bringing in your bank statements and all of that stuff now. Even the year is not over, let's get January to November and let's start working on it, because it's going to be a lot of crunching coming in January.
Correct. So this was like the example we were giving with the PPP. And basically we say, hey, this is pre-COVID money, post-COVID money, your PPP expenses. If you were at a tax rate of 10%, you would owe $2,500. As of right now, because the law hasn't been signed into, the bill hasn't signed into law, if you took forgiveness, your taxes would jump to $7,500 because we would not be able to take those PPP expenses that you took under forgiveness. So that your forgiveness taken, your taxes went up by $5,000. Once the law is signed into the bill is signed into law, we don't have to worry about this. This is kind of outdated information as of yesterday. As you can see, it is changing so rapidly that your taxes are going to take some time, and we want to stress that as much as possible. So the early bird catches the worm, and especially if you're organized.
Yeah. And we got to think about the software providers too, because they have to update their forms, they have to update their formulas, and those things take a while. Some of the returns may not be able to be completed until those calculations are done properly.
So with the new rules, we know that one, the forgiveness is up to $150,000, no question. Anything above that, you have to do formula, and then you can take your covered expenses on your return. And that's what the new rules. Once again, it hasn't been signed into law, but I mean, it passed the House and the Senate, but we have to worry about that. So what are covered expenses? Covered expenses are basically payroll costs, rent, interest that you had on any debt, PPE, worker protection expenses. That was added into the new law, but you cannot buy real estate with this money. But when you come in, we'll have to go through it as much as possible. But with the new law, once again, we can take these covered expenses. Bookkeeping is the key. Clean books and records, because we know there's going to be audits.
Yes, they're going to be audits.
Actually, just some started already.
Yeah.
People have been receiving letters saying, and it's soft. It's really quiet audits. Say, oh, can you send us your Schedule C? Can we take a look at what you had in your Schedule C? Or can you send us your books and records? So if you see those letters, it's basically a soft audit that's coming through, because they want to make sure how you're spending that money once we file the tax return. So the delay of payment of employer payroll taxes, I don't know if you heard it, but there was a big thing where the Trump administration will allow you to speak to your employer and stop a portion of your Social Security taxes from any wages that are paid from March 27th to December 31st and defer it. So you would pay that Social Security taxes in 2021. So with the new law, they said, hey, instead of having to repay it by April 30th, 2021, they've extended it to December 31st, 2021. And I think the thing that we like the most about it, because we didn't really see that many employees talk about that, but self-employed. If you're self-employed and you are a single member LLC and you pay self-employment tax, this rule applies to you too. So when we do your return, we look at your taxes, we may be able to say, hey, you don't have to pay 50% of your self-employment tax, which is 15% of whatever you make after expenses. We can defer it. You have to pay it by December 31st, 2021, but it's a double-edged sword.
You still got to pay.
Yeah, it's either now or later. So, I mean, it gives you options. And I think that's one of the biggest things that's going to happen in this tax season. We're going to show you, hey, you can either go with this or you can go with that. We're going to show you different options. And as you can see, when we talked about the distribution from a retirement account, you have an option. This, if you're self-employed, you have options. So there's so many options that are on the table that we will be able to look at, especially for business owners. There's so many options that are on the table.
And that come back to the time frame for the return.
Correct.
You got to check this scenario and see what the tax liability was going to be. Check the other scenario, see what the tax liability will be.
Correct.
You want to pay the lowest amount of taxes under the law.
Correct. So what other thing with business is there is a qualified improvement property eligible for bonus depreciation. So what that basically means in regular language is if you made any improvements to your property and your business, if you rented or if you're a restaurant, in the past, we had to divide it over 39 years. Now we have the ability to either fully expense it out or divide it over 15 years. And if you did something on your 2019 taxes, we can go back and amend those taxes to basically get you more money back. So that is a big thing. And once again, the questions we're going to lead to the end because I know there's so much. I know there's so much to go over, and we have about like almost 15 minutes left. So I see all the questions. We're going to try to run through this. So that's it for the CARES Act for the businesses. So tax tips for 2021 to save you more money is very important. So one of the tax tips we're going to say right now is review your stocks. If you have stocks and bonds, do some form of harvesting and look at what your losers are and compare it to your winners and offset them. So that means if you have a stock, you look at your portfolio and you lost 5,000 on one stock, but you have 5,000 gain on another and you need money, you sell both of those and you have no taxable gain. So look at tax harvesting. Push and pull expenses. So push as much income to 2021. If you have a check and you could cash it in, well, not cash it, but if for business owners, you could push it to 2021. But if you have any expenses, try to pay it so you can take a deduction on it for your 2020 tax return. So once again, the charitable donations is a pull. So you can pull it into 2020 to take a deduction on your 2021 tax returns. Review your tax withholding. So when we do your return, most people that owe is because they're not really, their W-4 is off in some way or form. So we want to really review your tax withholdings during the tax season and a midsummer checkup in July. Let's check to see if your withholdings are correct. We do a really quick projection. And then there's a fourth quarter checkup around December, November to take that and take a look at it.
Yeah, that W-4, the form has changed. It got a little complicated. Some employers are still using the old system.
Yeah.
And that's throwing a whole lot of people out. So you got to make sure that you're using the current W-4 form and to submit the information to your employer.
Yeah. And then for business owners and self-employed, the same thing. Midsummer checkups, bookkeeping. Bookkeeping is very, very important. Even if you do it yourself, even if you use QuickBooks Online, we need to know what your income and our expenses are so we can project it out. And a fourth quarter checkup, midsummer tax projections are key to save taxes. So, Steve Jobs says the only way to do great work is to things that you love to do. And we think that 2020 has let people know that nothing is certain. You may have been working at a job for 20 plus years and they let you go. You may have been just starting a job and they let you go. So what we've learned is that, fuel your passion, create an LLC if you can. I think that LLC would be a great way to help with the taxes. You have at least 3 years to make a profit. So you have 3 years that you can have some losses. And you get some tax deductions, and you never know what happens.
Yes, owning your own business is so helpful with this new tax law and what's going on. So for me, as you said, creating an LLC, make sure you document it. We just can't put a business out of the air. You have to document your business. You have to form it so that you could take some of those tax deductions that you have as a business owner.
Yeah. And you know what? You don't really have to create an LLC, but one thing I would definitely say is report the income. We had a lot of clients that were, for example, we had a client that was cooking out of her home. And she's been doing this for years. She was grossing about $50,000. Did not want to put it on a tax return. Didn't want to do it. COVID hit. It affected her business. She was not able to qualify for the EDIL. She was not able to qualify for the PPP. And I had to explain to her, it's not on the taxes. So you think you're saving yourself by not reporting the income, but you're actually hurting yourself. And one thing should be very evident. This is not going to go away. And I'm not talking about the virus. I'm talking about that when the government, it is time to help, they're going to help people who have reported their income and expenses.
Yes, and that's not all because of the government helping you to to give you funding or all of that stuff. Mortgages,
Yeah.
mortgages. When you're looking to buy a home
Hmm.
and there's income that is needed, and you have income that is not on the return, it's not going to be considered.
And apartments. I mean,
Yeah,
once this whole COVID thing is over, landlords are really going to dig deep into your finances. So if you're even trying to rent something, you would need to show profit
yeah,
on
the
there
tax
if you
return.
have it. Stay in contact with our office. We are open all year long. We do not close down. We are open all year long. Call us. I mean, a 10-minute call is not going to cost you anything. We'll speak to you, but we basically charge for preparation if there's some type of projection that needs to be done. Feel free to call us, send us an email. I know it takes us some time to get back, but as you can see, we're trying to help as many clients as humanly possible by giving them advice. Before you take money out of your 401k, call us. Before you go into an invest into a business, call us. We can give you some really good tax advice that can help you out.
And the same thing with you think in terms of buying a house, think in terms of starting a business, give us a holler
Yeah,
before you start those things because income tax returns is so important when you have to present your documentation to the lending institutions or the SBA or whoever is going to be giving you money.
very true. So, the new stimulus package. We're going to try to run through this in like 5 minutes. But there's so much. And once again, there's 5,000 pages. We weren't able to review every single page, but let's just jump into the new stimulus package. So this is as of today. The text of the bill is not fully published and it's not been signed into law. So we're just going over what we've read and what we understand in our community. So the stimulus check, $600 if you are single, $600 for adults. If you're married, of course, because 2 adults, 1,200. Had a household, 6 to 1,200 or more, and then $600 per dependent.
Depending on the 17.
Yes. So $600 per eligible adult, $600 per dependent under the age of 17. If you are over the age of 17, you get nothing. Now, the question is, when does that age start? And I'm thinking if they issue the money in 2021, they should be under the age of 17 as of December 31st, 2021. Once again, we don't know. But if you have a dependent that is over the age of 17 and they are in your return, they will not receive that $600.
Based on the nature of the law and how they normally write these things, I would say the person would have to be under 17 as of December 31st, 2020.
Okay, I would go with that too. And now, which is really key, a U.S. citizen or with a non-citizen spouse can apply for this and get it. In the past, when they had the first one, if you are married to someone who is not a citizen and just had their green card or their resident alien, you weren't able to get it, but you could get it now. Another thing, non-citizens who pay taxes and are not married to U.S. citizen qualify. So when the DACA thing happened a couple of weeks ago, we had a lot of individuals coming in to get W-7s for their children to apply for school. The W-7 gives you what's called a tax ID number, an ITIN number. It's a 9-digit number. It's not a social, but it's a 9-digit number. If you have that, now you can qualify for this. So if you know anyone that is in the country and they don't have a tax ID number, tell them, fill out a W-7. You may not be able to get this stimulus, but once again, I'm sure when Biden comes in, there may be another round of stimulus that will come. So it'll be in your best interest to fill out the W-7. And the good thing is we have an office in Newark and in Bloomfield that are certified to do this. You don't have to send your passport to the government. We can self-certify for you.
Right. And we didn't want to touch on the immigration piece because there might be an immigration bill coming down.
Yeah.
And filing a tax return, especially for those non-citizens, getting your tax ID number and being in the system would get you, I would think, head of the line.
I agree with that too. So the pandemic unemployment, the $300 has been reinstated. Was supposed to end in, I think, after Christmas. I forgot. But now there's additional 10 weeks, at least March 14, 2021, you can still receive that additional pandemic unemployment on top of your regular unemployment. So that's really good. The third round of PPP, businesses that did not get it in the first or second round, you could get it into this third round. And they're really focusing on minority and women-owned businesses that are located in low-income communities. So if you didn't receive it in the first or second round, because as we know, banks were really, it was really shaky with banks. So now what they're basically saying is like, hey, banker, if they are a low-income community, definitely try to help them out as humanly possible. And now that we know $150,000 will be basically forgiven, this is kind of free money.
Yes, you need to apply.
You need to apply for it. So I would say, definitely come and file your tax return, because they're going to look at what that income was. And you have to show losses of income of 20. If you want to go back in, so let's say you went to the first round or in the second round, you can go back in for the third round, but you have to show that your losses were 25% more than 2020 over 2019, which is a big tip.
And it's going to come back to the bookkeeping and your records.
Very true.
The actual profit and loss and all of these good stuff.
Yeah. I think one thing that you start to see is that individuals get to $600, but the businesses giving you almost $150,000. And with the EDIL, they put $20 billion into the EDIL program, another program that is great. Well, once again, it's a loan, it's not taxable income, and you can submit for multiple businesses. So if you have a catering business and you have a web design business and you have a notary business, you would file all those separate businesses on a Schedule C. You can apply for the EIDL. So I think it's very evident. A lot of these bills are for businesses. Yes, it helps the individual, but businesses get the butter on the bread, whereas individuals get the bread, but that butter is not on there. So I think that's a big thing.
And I noticed with the new law, they extended like to nonprofits. They do more things to catering places, restaurants.
Correct.
They extend the EIDL to cover these other businesses who were really crushed.
Very true. Meals and food expense. So now, once again, businesses in 2021, you'll be able to deduct 100% of your meals. In the past, what would happen is if you are a business and you went out with a client and you had food, you can only take 50%. We are now allowed to take 100% of that meals expense. So once again, businesses are getting a lot of love. It cannot be lavish. You're not taking them out to a full steak dinner at the most expensive restaurant. And, either an employer or business associate has to be in there. It can't just be you and your family talking about business, only if the family is in the business. But this is a really good one. This has never been around. Yeah. It's always been 50%. So this is a really good change. So eviction moratorium has been extended. So now if you are potentially an eviction, they have extended that eviction moratoriums. But on the flip side, for landlords, you can get a PPP loan if you have an apartment building or a rental property. So I think that's a big move in the right direction, because landlords, I understand their feeling is like, I understand I don't want to go to you to ask you for rent because I know you don't have a job, but at the same time, I need to pay the mortgage. So that PPP that goes to apartment building owners is a good move. So the earned income credit or child tax credit, that look back period. So what that basically means is, let's take, for example, you had earned income credit in 2019. 2020, COVID hit, you went into unemployment. Unemployment does not help you get earned income credit or child tax credit. We have the option to look back at your 2019 income and use that on your 2020 tax. You were talking about that. Mm-hmm. So that's a very good, it will help a lot of individuals. Yeah. So once again, even the simple returns, which usually the earned income credits can sometimes be simple and complex, it's now getting complex because we have to look at what is your income in 2020. Then we have to look at what is your income in 2019 and what will give you the best bang for your buck for the earned income credit or the child tax credit. So the 2 weeks that we spoke about, it's still there. Thank you for your time. Thank you for listening. This is recorded. We're gonna upload it onto our website. Feel free to share it with anyone that that's inside our Taxko community. Is there anything else?
Well, we're going to be continue doing more of this.
Yeah.
And we're going to be, doing specific topics.
Yeah.
As we go along. So just be in tune, and you'll see, specific topics. This was a broad topic.
Oh my God, it was very broad.
Broad topic. So we're going to kind of bring it down to some specific topics where we could, be more focused on what we do.